Your credit score is one of the most important numbers in your entire financial life. Think about it, this single three-digit number can determine the interest rate you get on a car loan, whether you're approved for a mortgage, and even how much you pay for car insurance. It can open doors or slam them shut. Today on Financial Essentials, we're demystifying this powerful number. We're going back to basics with credit score 101, what it is, how it's calculated, and most importantly, how you can build and improve yours to unlock a better financial future. Ready to take control? Let's dive in. So, what exactly is a credit score? At its core, a credit score is a number that predicts how likely you are to pay back money you've borrowed. The most common scoring models, like FICO and VantageScore, range from 300 to 850. A score of 300 is considered very poor, while a score of 850 is perfect. The higher your score, the better you look to lenders. When a bank, credit card company, or landlord looks at your score, they're trying to assess risk. A high score tells them you're a reliable borrower, which means they're more likely to approve your application and offer you favorable terms, like lower interest rates. A lower score signals higher risk, which can lead to denials or much more expensive borrowing costs. It's essentially your financial report card, and just like in school, you want to aim for the best grade possible. Now, let's break down the secret recipe that makes up your credit score. While the exact formulas are proprietary, we know the 5 key ingredients. The first and most important factor is your payment history. This makes up about 35% of your score. It's simple. Do you pay your bills on time? Next up, accounting for about 30%, is your credit utilization. This is the amount of credit you're using compared to your total credit limit. After that, we have the length of your credit history, which is about 15% of your score. Lenders like to see a long, established history of responsible credit use. Then there's your credit mix, which makes up 10%. This looks at the different types of credit you have, like credit cards, a mortgage, or an auto loan. A healthy mix can be beneficial. Finally, the last 10% is new credit. This tracks how often you're applying for and opening new accounts. While all 5 are important, if you want to make the biggest impact, you need to focus on the top 2, payment history and credit utilization. Mastering these 2 areas is the fastest way to a healthier score. Let's really dig into why payment history is the king of credit score factors. It's the single biggest piece of the puzzle for a reason. Lenders want to know, above all else, if you have a track record of paying your debts as agreed. Every single late payment can have a significant negative impact on your score, and that negative mark can stay on your credit report for up to 7 years. Even one 30-day late payment can cause a substantial drop. The best defense is a good offense. Set up automatic payments for all your bills. Even if you just set it for the minimum payment, it ensures you'll never be late. You can always go in and pay more later. Use calendar reminders, phone alerts, whatever it takes to make sure you pay on time every time. Consistency is your best friend here. A long history of on-time payments is the strongest foundation you can build for an excellent credit score. Next, let's talk about the second most important factor, your credit utilization ratio. This might sound technical, but the concept is simple. It's the percentage of your available credit that you're currently using. For example, if you have one credit card with a $10,000 limit and your current balance is $2,000, your utilization is 20%. The golden rule here is to keep your overall utilization below 30%. So, across all your cards, you want to be using less than 30% of your total available credit. But if you really want to optimize your score, aim to keep it under 10%. Lenders see low utilization as a sign that you are overextended and can manage your money responsibly. A high utilization ratio, on the other hand, can be a red flag that you might be in financial distress. A great tip is to pay your balance before your statement closing date. That way, the lower balance is what gets reported to the credit bureaus. You can also responsibly request a credit limit increase on your existing cards, which will instantly lower your utilization ratio as long as your spending stays the same. What if you're starting from square one with no credit history at all? It can feel like a catch-22. You need credit to build credit. But don't worry, there are several great ways to get started. One of the most common entry points is a secured credit card. With a secured card, you provide a cash deposit, which usually becomes your credit limit. You use it like a regular credit card, and your responsible payments are reported to the credit bureaus, building your history. Another excellent option is to become an authorized user on a family member's credit card, as long as they have a long history of on-time payments and low utilization. Their good habits can become part of your credit report. You could also look into a credit builder loan. These are small loans where your payments are reported, and you get the money at the end of the loan term. It's like a forced savings plan that builds your credit. Start small, be consistent, and your score will begin to grow. Okay, so what if your credit score isn't just new, but it's been damaged? Maybe you've had some late payments, a collection account, or just made some financial mistakes in the past. The good news is, no score is beyond repair. It just takes a plan and some patience. Your first step is to pull your credit reports from all three major bureaus: Equifax, Experian, and TransUnion. You can do this for free annually. Go through them with a fine-tooth comb and dispute any errors you find. Incorrect information can unfairly drag your score down. Next, focus on bringing any past due accounts current. If you have accounts in collections, you may be able to negotiate a settlement or a pay-for-delete agreement where they agree to remove the negative mark in exchange for payment. The most important thing is to stop the bleeding and start building positive history from this point forward. It won't happen overnight, but every on-time payment and every dollar of debt you pay down is a step in the right direction. Let's wrap this all up into a simple, actionable credit boost plan you can start today. First, automate everything. Set up autopay for the minimum payment on all of your credit cards and loans. This is your safety net against late payments. Second, attack your balances. Focus on keeping your credit utilization below 30% and ideally under 10%. Pay your cards down before the statement date. Third, be selective about new credit. Don't apply for a bunch of new cards all at once, as this can lower your score temporarily. Only open new accounts when you truly need them. And finally, monitor your progress. Use a free credit monitoring service to check your score and reports at least once a month. This helps you stay motivated, catch any potential issues early, and see the positive results of your hard work. Your credit score is more than just a number. It's a tool that can help you achieve your financial goals. Understanding how it works and taking proactive steps to manage it puts you in the driver's seat of your financial life. It takes time and consistency, but building a strong credit score is one of the best investments you can make in yourself. Thanks for tuning in to Financial Essentials. If you found this helpful, be sure to hit that subscribe button for more smart money strategies to help you build a brighter financial future. We'll see you in the next video.